Good morning. Welcome to another episode of Bypoint ASX. I'm Mac in Oz. This morning we're looking at the REA group, REA on the ASX, a company that will be very well known to most Australians. Here is the basic black chart. You'll see that since its inception at the turn of the century, REA has enjoyed remarkable and remarkably consistent growth. Here is COVID. Here is REA's very strong response to COVID, given that the Australian real estate industry, I suppose the world's real estate industry, went crazy with everyone having to stay at home. This is the sea change and tree change movement of people in response to the pandemic. What you might see as interesting is that down here the company pretty much sailed through the GFC without a scratch, which is remarkable in itself. Okay, here is the simple chart for the period since COVID, which is obviously of greatest interest to us. Again, you can see the very strong response. But this growth line essentially took up from where it left off before COVID, and what you have seen recently is a sideways movement. Now, what most people are going to tell you is that this is the result of the entry into the market of the American company CoStar, which purchased realestate.com's primary rival, Domain, from Channel 9, and has been making all sorts of noises about shaking up REA's essential monopoly, at least in the Australian real estate market. And this is why it is of interest to us today. Here is the close-up of the current situation with this now, nearly a year of sideways movement with REA. As you can see, there have been a number of buy points here where the MACD line cuts above the signal line, below the zero line. We had the Trump chaos. Then we had what was probably something to do with attempts by REA to expand its network globally that we'll talk about in a minute. And here you see that the MACD indicator is again heading below the zero line. I'll just move this out of the way for the moment. You'll see that the indicator isn't actually below the zero line as yet, so this isn't a absolutely imminent buy point, but it's one that is coming. Now, again, just to remind people who aren't familiar with the methodology, what we're looking for, here's a brief, or let's say a simple explanation of the MACD chart. Here you have the zero line. Here you have the histogram. Here you have the MACD line. Here is the signal line. If you want to understand it more, I recommend you go off to Investopedia and take a closer look. But this is what we are focused on. This is what we suggest to you is the single most reliable indicator of the best time to buy any stock, subject to, of course, the overall golden rule of technical analysis that you never act on the basis of a single indicator. Okay, now as I have been mentioning in the video since we restarted, with MACD analysis, the MACD becomes a less reliable indicator when the stock starts moving sideways on the chart. That's because the amplitude of the movement of the MACD lines above and below the zero line starts to shorten, and that makes the MACD a less reliable indicator. One of the alternatives in terms of identifying a buy point that I'm currently looking at with stocks that have gone into consolidation is the theory that as the volume traded on the stock starts to lower, you can see that the market is extracting all the liquidity around the stock before a move. Now, I find this interesting, very hard to assess. You would see here, I would say, that you couldn't say, given this area over here, that there has really been a significant diminution of the volume of the stock traded. Lots of people selling recently, but it is something to keep your eye on. What can't be denied is that REA has been trading sideways around this price of $240 for nearly a year, and the working theory is something's got to give. Here are the basics as far as REA is concerned. You can see it is one of the larger companies on the ASX with a market capitalisation of $31 billion. You can see that revenues have remained consistently strong with a bit of the dip for COVID. You can see that the operating margin is perhaps falling, but rising again, and you can see this fantastic net profit that they declared last financial year. PE ratio isn't anything to write home about, but this is an indicator that what we are looking at is not a real estate company, it is a digital company, hence the title of today's video. Because here is the spreadsheet of all the brands operating under the REA umbrella, and what all of these brands essentially share in common is a significant investment, or if not a 100% commitment or involvement in the digital space. So anything that ends with a domain name is a digital space. PropTrack is a data analytics area. Lytics is obviously analytics. You can see that there is international diversification, and what we have down here was something that might be of interest moving forward. This was the most recent activity of REA trying to purchase Rightmove, which is a British company similar to realestate.com, and that didn't happen because they simply weren't able to get the board of Rightmove to accept their offer. And here's a little bit of coverage about that. Now, is this the beginning of some sort of setback for REA globally? I think not. The one thing that we know about REA is that it is primarily being propelled within the News Corp organisation by the heir apparent Lachlan Murdoch. It's his baby. So I think to the extent that there is a competitor looming, you're going to see REA react aggressively to hold its dominant market share and to generate profits in the future, which is why the stock is the subject of today's video. Here's a disclaimer. Thanks for watching. I'll see you tomorrow.